Caroline, how do you interpret the latest Fed commentary? Because, these comments from Richard Clarida, he's talking about tapering, perhaps in forthcoming meetings. And you might have thought that could have caused a bit of a tantrum. But I suppose given the Fed minutes, we'd already heard this narrative from the Fed. Why do you think markets are so relaxed about this taper talk?
Yeah, I think it's such a sort of long glide path, isn't it? We're talking about talking, we're hinting. Our view is that they will probably make an announcement around the plans to taper later this year, and that the taper itself would occur next year. And I think, as we get through those sort of timelines where we get closer to the event actually happening, that the yields probably will start to creep a bit higher. But it's such a gentle communication, and there are sort of so many steps involved. I think they're trying to sort of manage the market slowly towards it. And I guess that's what's happening with the market, not suddenly shooting up on the bond yields.
Good morning, Caroline. I know you still believe that the reflation trade has plenty of legs left. Is that on the idea that inflation won't run away too much, but most importantly, even if it nudges higher, the Fed will stay very, very dovish? Or do you think that it's that we'll get much more inflationary impulse, but as long as the Fed stays way behind, it doesn't matter? So how does that kind of tie in with the inflation view?
Mm-hmm. Yeah, it's probably more the former. We think that obviously inflation is going to run above target, particularly in the US. Last month it did and probably will for a couple of months, but that it will gently come back closer to their target. So we don't have the view of sort of runaway inflation. We very much support the transitory argument. With that backdrop, we do see that there is scope for yields to move higher, particularly with the strong economic growth backdrop that we have. And as the yields move higher, and our forecast for the 10-year Treasury is 2% by the year end, then that supports the sectors that are reflationary. So, for example, financials, energy, materials, which are also trading actually at, quite cheaply versus other parts of the market. And they're also the sectors that are offering the highest earnings growth. So there's lots of different factors to drive those particular sectors forward.
And thinking about what inflation concerns do to stocks, or what higher Treasury yields do to stocks, Caroline, I was interested to look at this chart of inflation-adjusted earnings. This for the S&P 500. Inflation-adjusted earnings yield has fallen below zero, and that is quite actually a rare occurrence, not since the financial crisis. It's hit a 40-year low, and I wonder if this gets you thinking about that link between inflation and stocks, and any work that you might have done on that front. I take on board the comments you said about it'll be different for different sectors within the S&P 500, I guess.
Yeah, exactly. And, I think, moderate inflation is usually pretty helpful for stocks. It depends, obviously, how much the bond yields respond to that. As I said, our view is that the bond yields will move a little bit higher, but we view that as a positive thing. It's a more normalization. It's sort of quite abnormal to have the bond yields as low as they are. If the yields move significantly beyond sort of 2.25% to 2.5%, then we think that could start to obviously have an impact on the rating of the equity market. And then it's more difficult to generate positive equity performance above those bond yield levels, because you need to make sure that the earnings growth is outweighing the derating. But up until sort of 2.25% to 2.5% on Treasuries, we don't think it has an impact, particularly on the equity market, unless the move is very, very sudden, as we saw earlier in the year, which did cause a bit of market concern.